Welcome to the Voices of Self-Funding podcast. I'm your host, Tom Testa. Each episode, I'm joined by leading self-funding experts for a deep dive into impactful topics and perspectives surrounding the self-funding industry. Our goal is simple, to give you practical insights you can put into action, whether you're a TPA, a broker, or an employer. Joining me today is Joe Dore, the president of USBenefits. Joe, welcome to Voices of Self-Funding.
Thank you very much.
Joe, glad to have you here. Got a bunch to talk about. This is a topic I am very unfamiliar with, so I'm glad you're going to be educating me as well as our audience today. Before we dive into the heart of our conversation, tell us a little bit about yourself and USBenefits and your role in the stop-loss industry. Talk to us about that.
Sure, Tom. So I've been in the insurance industry for a very long time. Since we're on the podcast, you can't see, but I'm an older guy. I've been in the business for about 40 years now. I was invited to come over to USBenefits in 2020 to help reshape the organization. My background is property and casualty. I come from the workers' compensation space. There's a lot of similarities between the two product lines. In work comp, over 70% of the claim dollars paid are medical. So it was a good transition. I've done excess program. So it was a good move for me to make this. USBenefits is a full service MGU. And what that means is that we act on behalf of our stakeholders, carrier partners, reinsurers. We do the underwriting, the marketing, the claims, and we handle the accounting, the administrative portion. For all intents and purposes, we act as if we are an arm of our stakeholders.
That's interesting. And tell us again, I know you briefly touched on, but who are some of the stakeholders that you work with daily? The overview of kind of the types of stakeholders.
We believe in having a very strict relationship. So we have an exclusive relationship. When I say exclusive, we have one carrier that we work with. We don't work with multiple carriers because we believe there's a tremendous amount of value to that. We also work with several reinsurers, and our objective is to bring the best possible outcomes, not just to our stakeholders, but to the employers. We try to do it at the end of the day, and we've been fairly successful at this, and we can talk about where we've made the differentiating marks later in our discussion.
Okay.
We hear this overused term, the trusted advisor, but we really strive to be that point of contact for our customer base when they come to us and say, hey, we've exhausted all the resources. What can you do? And our customer base consists of TPAs, brokers, consultants, and we try to be a resource to all parties.
I love that. Joe, I want to dive a little bit into our discussion on some of the big topics and issues you're seeing that are impacting the stop-loss industry and the self-funding industry. There's been a lot of discussion about rate increases, but the market has stayed pretty competitive. What's really happening behind the scenes with stop-loss pricing right now as you see it, Joe?
You know what? It'd be interesting to get 10 of us in the same room and compare notes.
Okay.
So I'm going to speak from our experience and our perspective, while I would say that maybe the likes of a larger carrier or a different MGU who may specialize in an industry may see something different. Okay. What we are seeing is a mixed bag of results. And what I mean by that, if an account performs well and they're profitable, we do not see any rate increase. In fact, we see them running pretty tight to current pricing levels, if not even more aggressive as what we saw in previous years. Now, if an account is marginal, we are starting to see that. What we are seeing, though, I should preface, is that the market is testing the waters. What I mean by that is the market is coming out and saying, we want a 20 or 30% increase. Whether or not they get it is a different story, because as we get closer to binding the account, more often than not, the incumbent will reduce their price to retain the account. The accounts that are getting price increases, however, are those that probably warrant the increases. They have questionable years. They may have multiple large losses or multiple lasers. Some of the accounts are not getting enough rate increase because, admittedly, their increases may be limited to the no laser rate caps provisions. Those carriers may be limited to only how much they can get. And for someone like us that may be looking at a new piece of business, we may see there's a greater need and we walk away. But overall, I'd say it's still a mixed bag.
What are the factors that are impacting that mixed bag? What are some of the exterior things in the industry that are impacting whether there's a price increase right now? Are there any?
I would say yes, there are price increases, and some of it is, like I mentioned earlier, is that the account could have multiple years of poor losses,
Okay.
a large number of lasers, and they're not willing to move the spec level. And that's another factor that we should talk about too, is that sometimes when you look at an account that may be getting a rate increase, are they really getting a rate increase or are they just moving the spec deductible, right?
Understood.
So there's a little bit of strategic moving, but I think overall carriers are trying to get rate increases, but there's still capacity in the market. And I also believe that some carriers may be trying to look at getting rate increases because on the overall portfolio basis.
Okay.
I don't know if they're going to be successful at it or not, but I will tell you, like I said again, I just repeat myself, is that when the accounts are good, the market will allow the rates to continue to get suppressed.
I want to talk about a little bit more about something you said at the start when you talked about USBenefits and really the importance of trust, a trusted partner, right? What's the biggest mistake you see brokers or employers make when selecting a stop loss partner?
I like to phrase it that I don't think brokers or employers make mistakes. It's oftentimes, I think it's their comfort zone,
Okay.
what their perceptions are. And I think oftentimes not having that conversation with their stop loss partner, understanding being part of their strategic planning. The way I see it today, we have been successful in developing relationships where we're no longer a silo. We become part of a plan. And I think that helps a lot. So I'm just going to throw this out there.
Yeah.
Brokers and TPAs work very hard on trying to serve the employer groups. I think at some point, my personal take is I think the employers groups needs to become more involved, more aware of the transactions that occur within their stop loss. So everything from $0 all the way up, then they can start understanding what is the role of stop loss. Because I think oftentimes when they think about it, they're thinking, well, why do I worry about my stop loss carrier? They're just going to pay for that loss above the spec deductible. Well, let's think about your car deductible. You have a $500 deductible on your car. So you're saying, hey, I don't care how much damage I create to my car because after the $500, I'm done. That's not true because the auto carrier is going to see that full-blown loss, right? And you can go anywhere you want to shop your auto insurance, and all auto insurance carriers are going to see the same loss. That's the same thing that happens in the stop loss arena. And I think employers need to be aware of that if they can control the losses in partnership with all parties, including the stop loss, that's critical. And I think that's where the education part comes in. And I think brokers and TPAs are challenged in trying to educate employers group where the value really stands. I also believe that there's a lot of needed communication among all parties to manage the outcome, as opposed to saying, here you go, stop loss carrier, here's our losses, do what you need to do. But if we can get involved or at least have dialogue, maybe there's planning that we can all do the same concurrently to come to the same outcome, if that makes sense.
It does. And back to the education component for a moment. Are the brokers, are they equipped to educate the employers? Do you think they have the resources they need to educate them?
That's an excellent question. I think as an industry as a whole, we do have a shortage of talent. We see it all the time. If you were to look at job postings, everyone's looking for talent, and there is a shortage.
Okay.
I think by that also, I think the other thing is we become more transactional as opposed to consultative. So again, it goes back to trying to educate across the board. To answer your question, I think we all have our weak spots and strengths. And I think good brokers know where those pain points are and where they can shine, and they take advantage of it. Others, unfortunately, they just treat it as transactions. And then we know what the outcome looks like when you treat anything as a transaction.
No, absolutely. That's important.
Take a quick sponsor break. You've been listening to incredible insights on the future of self-funding. But for you, the growth-oriented executive at a third-party administrator, a critical question remains. How do you turn these industry insights into market differentiation and real profitable growth? In a crowded market, winning new business against the big BUCA carriers is tough. you're constantly struggling with low member engagement and an overwhelming volume of tactical support calls. Zaki Point Health is your digital co-pilot for care navigation and growth. We provide a multi-touch mobile member experience that drives 3 times higher engagement rates and cuts your administrative burden. But we know you need more. That's why we built the Zara AI suite to tackle your largest service challenge: routine provider and member inquiries. Using our voice, our portals, and AI bot technology, the Zara AI suite cuts your provider call volume for routine benefits eligibility calls by up to 50%. This is a massive leap in efficiency and cost savings that directly impacts your bottom line. And the beauty of our platform is that it is integrated with your claims system to drive data-driven direction for members, providers, customer support reps, and employers. No more silos and questions about the integrity of your data. TPAs partnering with Zaki Point Health are experiencing over 20% year-over-year growth. We equip you with the differentiated tools to win new business, satisfy employers with clear ROI, and scale your operations. Stop struggling. Start competing and winning. Visit ZakiPointHealth.com today and request a demo to dominate the middle market. Let's get back to the show.
Question 2, and forgive my ignorance too on this, but you used the automobile analogy, which we all know very well. Even though that when the stop loss is higher than your deductible, are there premiums that go up each year because of that too? That still impacts that, is it not?
It should. It should.
Which I know we talked about earlier in the conversation, but those are things that still do impact that.
It does have an impact. And I think those partners that we have that understand that impact will reach out. I'll give you an example that occurred mid last year. Did all their resources in dealing with a potential high RX claim. It was cancer infusion. The expected cost was $2.2 million, and the renewal was coming up. So they reached out and said, okay, we know you're going to laser it. We've tried everything. Be gentle and be kind. What we decided to do was ask permission if we could get involved and reach out to the provider, reach out to the employer group, and see if there was an alternative. Through those discussions, we were able to successfully negotiate with the provider to reduce it to $1.2 million. And there was a similar situation where we were able to convince the employer group to talk to the claimant to consider a different infusion center. Same type of claim, and they accepted it, and we were able to save on that one $1.2 million. So significant savings. While we still lasered the account, I think the value of stop-loss carriers and how we approach things can be tremendous.
That's excellent. That's a great analogy, great story there. Thank you for telling that one. Question for you too, when back to high cost claims, when they do hit, like almost the story you're talking about, what separates a good stop-loss partner from an average one? And it sounds like in your story right there that you just told, I have a good idea, but tell us about that.
I think an example I'll give to you, actually one of the best examples I can give to you, goes back several years ago during the COVID period. We had a TPA that came to us immediately when they identified an individual that was identified with the virus. They already knew that that person was going to be in the hospital for some duration. As a result, they said, what do you want to do and how do you want to do it, USBenefits? We got involved immediately. We're able to successfully negotiate the claim well over 70% off the bill prices because we understood. And so I think that's the kind of relationship you want to have when you have large claims. There are some others that are very difficult to manage. And I know my counterparts out there are dealing with gene therapy and such. Those are different animals. Mm-hmm. And I think those require strategy. But the point is, the sooner that the stop-loss carrier can get involved, I think it's important for the TPA broker to know that they're not an island. They do not have to solve the problem by themselves. Because I think at the end of the day, if you go to our website, you'll see something. What we strive to do is bring the best possible outcome to the employer group. And I think, or the plan, however you want to define it. I think everyone in this lineup, the broker, the TPA, the employer, we all have the same goal. And I think if we all start talking more frequently, we can achieve those goals.
That's excellent. And it sounds like, too, from what you were saying earlier, I don't know if you agree with this, but it sounds like a proactive approach too, right? Not just
Absolutely.
knowledge, but being proactive, like you talked about in the COVID example.
Yep, and I completely agree. The proactiveness is important and not to get constrained by the norms. For example, don't wait for the 50% reporting to tell us something. If you know it's going to blow up, let's have that dialogue now. Coming from the work comp industry, I'll give you an example. If you know that you have a 50-year-old man who has a strained back, the likelihood of that individual recovering within a week or two is probably pretty slim. It's not like a 20-year-old. Recovery rate's a little bit longer. If the person has a pre-existing injury, maybe had a surgery in the past, likely aggravation to the injury, maybe they might have to go back into surgery again, possible. If you know that's going to hit the spec and you see that claim come in the door, why not have the dialogue now?
Yeah.
Right? Why wait for the triggered diagnosis report? Why wait for the 50% report? And I'm oversimplifying this, but I'm trying not to make it complicated because I'm hoping that there's an employer group that will listen to this and go, hey, that makes sense. How do we get somebody involved quicker and faster? And that's not to say the TPAs are not, but if you know it's going to become somebody that you're going to involve other parties, get those parties involved now, right?
That's great. No, I love it. You're advocating, which I think adds to that level of trust that you talked about
Yes.
earlier.
Yes, and there's at the same token, there are some networks out there or providers that don't negotiate. Should a broker or TPA is aware of this, then why wait for the bills to rack up? Let's start that dialogue now, because if there's something that can help the claimant recover faster, better, and we can negotiate with the provider, or maybe this individual's going to this place because they think it's the only source for them and not realizing they can go someplace else. Again, it's getting the best outcome for the employer, the best outcome for the claimant. We don't want the claimant to have to deal with a doctor over and over again, right? We want them to get well. So hopefully that makes sense.
It does. It does, Joe. As we always love to talk about trends that are happening and impacting, I've got one more question for you. What do you see as a current or emerging trend that's going to continue to impact the self-funding industry throughout the rest of this year? What do you see? I'd love to know, get your forward-thinking hat on. See, what do you think about that?
Wow, Tom, that's a lot of stuff, but I would say the immediate thing is to look at the escalating costs in medical costs, whether it's treatment, RX, dealing with that on the frontline basis. It's not just going to this year, it's going to continue. And how do we address that? Are those costs necessary? I know that we're seeing legislation at the federal and even local levels addressing those issues, but is that enough? Because at some point, it may become cost prohibitive for even what we see today, because employer groups are trying to save money while providing the best service. But at these continued prices, it's going to be very, very challenging.
That's interesting. And like you said, something you're going to see that isn't going to be solved in 2026 alone.
No. And what I caution it only because when the market does change, because we've been talking about the firming market for years now, right? And whether or not it actually comes or not, but we're starting to see some of it. My biggest concern is when it does hit, how far would that pendulum swing and how hard will it hit the employer group, right? I'm in the business of making money, admittedly, right? We're a business.
Sure. Yep.
And we're not in the business to put employer groups out of business. But we have to find tactics that create that balance. And for years, if no one has looked at the stop loss industry, it has not made money for many, many years.
Wow. And I don't mean to push this, but if that correction happens, how do you see it impacting the employer?
I think employers that are savvy will understand how stop loss functions. And I should probably preface this. I think many employer groups are looking to save money by transferring from a fully insured product to a self-insured product, not really understanding the dynamics. In my personal opinion, stop loss is an excess product. And what I mean by that, it is an insurance product, but it really is a financial product because you're not paying for your full premium up front. You're paying as you go along for your claims. So you have cash flow benefits, you have tax benefits. These are things I think an employer group needs to strategize and say, how do they maximize this? And I think when they start looking at it and addressing how do they tackle claims proactively, strategically, that will make a difference. And then starting to learn to, like I said, I'm just repeating myself, partner with everyone in the chain because we all work for the same goal. I think that will make a difference. But I think when the employer group starts to realize how they can really use this as a financial tool, less as an insurance tool, it will make a difference. But this applies to more so larger groups, if you will, maybe 250 lives or more, where it would make a difference. They're taking larger deductible limits, taking on more risk.
That's great. Joe, can't thank you enough. Joe Dore, this has been a fascinating conversation. Thank you so much for joining us today. Any final words before you leave the Voices of Self-Funding show?
No, I look forward to doing another one with you, Tom, and thank you for the opportunity to join you on this conversation.
It's great. No, thank you, Joe, and best of luck to you in USBenefits. If you'd like more information on USBenefits, visit their website at usbstoploss.com. You can also connect with Joe on LinkedIn. That's all the time we have for today's episode of Voices of Self-Funding. This program is brought to you by the Healthcare Administrators Association. For over 40 years, HCAA has supported third-party administrators and the self-insured employer industry through unmatched educational opportunities led by industry experts. To learn more about becoming a member, visit hcaa.org. Be sure to like and share this podcast on your favorite platform so we can continue to grow a community of like-minded professionals. I'm your host, Tom Testa. Take care, everyone.